Financial management. Today I am going to discuss about financial management. What is meant by financial management? What are the advantages of managing efficient flow of funds? Here, financial management is concerned with the managerial decisions that results in the acquisition and financing of short-term and long-term credits for the firm. Generally, financial management is focused on how to raise the funds and how to efficiently utilize the funds. So it is also defined as the management of flow of funds in a firm, and it deals with the financial decision making of the firm. It also includes any decision made by an investor that affect his finances. So here main emphasis is optimum utilization of the funds at minimum cost. What do you mean by minimum cost? When the financial manager raising the funds, he should be very careful about at the cheapest source of fund. Cheapest source of funds means minimum cost of capital. With the help of minimum cost of capital, he has to raise the fund and give or earn highest rate of return. So that is one of the important aspect of financial management. It is also defined as the operational activity, operational activity of a business unit is responsible for obtaining and effective utilization of funds necessary for the efficient operation. In other words, or we can simply say that financial management refers to all activities related with forecasting, raising, monitoring, and managing of funds used in business. It is also related with the obtaining and deployment of funds in an appropriate manner. So this is the main aspect of financial management. Next thing is, again, the term is explained in a simple way. Financial management is also referred to as planning, organizing, and controlling the monetary resources of an organization. It also helps in improving the allocation of working capital within business operations. It reviews the financial health of the company by using tools like ratio analysis. So here important aspect is discussed. It helps in improving the allocation of working capital. What do you mean by working capital? Working capital refers to the difference between current assets and current liability. What do you mean by current assets? Current assets are those assets which can be converted into cash within a short period of time. Current liabilities are those liabilities which should be repaid within a year. That is called as a current liability. The financial health of an organization can be assessed with the help of the tool ratio analysis. What is meant by ratio analysis? Ratio analysis is one of the important tools of financial analysis and interpretation. It helps to find out the relationship between any two aspects, either current assets and current liability, like that. We can identify the profitability, solvency, profitability, turnover of the organization. That is one of the important advantages of ratio analysis. Next thing. What are the objectives of financial management? That we will discuss in detail. Objectives of financial management. It is generally every firm wants to maximize the profit. It is even we can say that universally accepted objectives of any organization. What is meant by profit maximization? Profit maximization is nothing but the difference between the revenue and minus cost. It means the difference between the revenue and cost. Every firm wants to earn more than the money spent on producing the goods. So that is called as the profit maximization. Another important objective is the wealth maximization. What do you mean by wealth maximization? Shareholders, it is otherwise denoted as shareholders wealth maximization. When a shareholders invest in the company, take example, The share price is rupees 150 at the time of the purchase. After 5 years, the share price is increased to 1000 rupees. That is called as the wealth is maximized. What do you mean by wealth is maximized? The market price of the share is more than the price at which the shareholders purchased. That is called as a wealth maximization. Okay, now we'll discuss in detail what is profit maximization and wealth maximization. The objective of the financial management is to earn maximum profit. Every firm wants to earn maximum profit. The return on investment must be high. Various important decisions are taken into consideration for maximizing the firm's wealth. Here, the various decisions means financing decision, investment decision, and dividend decision. All these decisions are taken into consideration for maximizing the profit of the firm. If the company does not earn good profit or good return and fails to distribute higher dividend, the people, that is the shareholders, the people would not invest in such a company. That is, the public will not be interested in such a company. So the reputation of the company in the marketplace, that is among the public, is decided based on the distribution of the dividend and earning capacity, as well as the projects in which the company is investing. So that is the important criteria in which the profitability of the company is assessed. Next thing, wealth maximization. Wealth maximization is otherwise called as a shareholders' wealth maximization. The objective of wealth maximization of shareholders consider all future cash flow, dividend, earning per share, risk of a decision. Risk is also one of the important aspects before undertaking any financial decision. Every manager will consider, the finance manager consider risk and return aspect. There is a relationship between risk and return. When there is a high risk, automatically it results high return. When there is a low risk, it automatically results low risk. Example, when you invest in that fixed deposit, the risk is zero. Similarly, the return is also less, nearly 4.5 percentage to 5.5 percentage or 6 percentage. That is the maximum return an investor can expect. But in case of when the shareholder and the people have invested their money in share market, automatically the risk is also high, as well as the return is also, the chances of earning return is also high. So the risk return relationship must be, every manager should analyze. Shareholders are always interested in the maximization of wealth, which depends upon the market price of the share. When the market prices shoot up, automatically the company, that is a shareholders' wealth, is also increased. There is a direct relationship between the market price of the share and shareholders' wealth. Increase in market price leads to appreciation in shareholders' wealth and vice versa. So the major goal of financial management is to maximize the market price of the equity share of the company. So the two important objective of any financial management is profit maximization and wealth maximization. Profit maximization is earning the profit. They will not consider the timing of the return, all this thing. But as far as wealth maximization is concerned, it is direct relationship with the share, increasing share price. That is the whatever invested in the share market, the price must go. Then only we can say that the shareholders' wealth is maximized. Now we'll discuss profit maximization versus wealth maximization. But profit maximization alone cannot be considered as one of the important objective. It is also one of the objective, but it cannot be treated as a primary objective in the traditionally it is considered as the primary objective. Now in modern aspect, we cannot consider profit maximization alone, cannot be a primary objective. So here, what is an important limitation of profit maximization is timing of the return is not considered. then the rate of return which he earned cannot be identified or cannot be equated with the net present value of the money. That is one of the limitation of ignore. Another thing is that it ignores the time value of the money. That is also one of the important limitation of profit maximization. So profit maximization can be considered as a part of the wealth maximization strategy. Please understand, it is a part of the wealth maximization, but should never be permitted to overshare the later. We cannot compromise the wealth maximization for the sake of profit maximization. So throughout the life of the firm, the objective of maximization of shareholders' wealth has been taken as the primary goal of the financial decision making. I think it's clear. So what is profit maximization? Profit maximization is increasing the profit of the firm without considering the shareholders' wealth. That is the revenue minus cost. But wealth maximization concept means here increasing the share price of the company. That is one of the important aspect. It is measured with the help of the increasing share price as well as increasing the investment of the company. So this is the one of the important aspect of profit maximization and wealth maximization. Next, another important thing I would like to explain how firms cash flow and value maximization. Here you can see that important thing is short-term funds. Here left hand side you can see that this is short-term funds, here long-term funds. So short-term funds are used to acquire temporary working capital. Long-term funds are used to acquire fixed assets and permanent working capital. Both the assets are, that is, temporary working capital and permanent working capital are used to generate net cash flow inflow from operation. These two capitals are used to generate the inflow. So from this, out of this fund is, once the money is generated, it will be used to service debt obligation, dividend distribution, retained earnings. What is meant that? Service debt obligation means when the firm, there are two important sources of financing for a firm. One is a owned capital, another is a leverage or borrowed money. When the company when the company borrows money, it needs to pay interest periodically. That is called as a service debt obligation. It has to pay interest. Next thing is the dividend distribution. From the profit in the company has two options, either to distribute the dividend or retain the earnings available. So that is the important thing. When the company distribute the dividend in cash, there is the opportunity of multiplication of the profit is not possible. But when the company will retain the profit which is available to the shareholders, when the company feels that they can generate by utilizing this profit, they can multiply the income to the shareholders. In that case, it will retain the earnings. It is otherwise known as retained earnings that can be utilized only when the firm is having profitable investment opportunity. Okay, so these three aspects leads to firm's wealth maximization. So when the firm is able to repay its liability, when the firm is able to distribute dividend, then when the firm is able to retain certain portion of the profit for the future growth, it means that firm's wealth maximization. So firm's wealth maximization is nothing but when the firm is maximize its wealth, ultimately it leads to the shareholders' wealth maximization. So this is the important aspect of wealth maximization and shareholders. In another important thing we have to study under wealth maximization. This is the one of the important element under wealth maximization, that is nothing but EVA. EVA is nothing but economic value added. Economic value added is a financial performance method to calculate the true economic profit of an organization. It is it is based on the past performance of the enterprise. It is one of the important indicator to measure the performance of the company. The main economic principle in this method is to determine whether firm is earning higher rate of return on the entire invested funds than cost of funds. It means that the firm should be able to earn more than the cost of capital. So what is meant that? Let us take the example of borrowing money from the bank. So bank is lending money at the rate of 15%, you assume. By utilizing the fund, the company is investing in the profitable investment opportunity. By utilizing the fund, the company should be able to generate more than 15%. Then only we can state economic value is added. Suppose the company is able to earn less than 15%, then in that case, the company may push into the stage of loss. So that's why economic value added is equal to net profit after tax minus cost of capital. Next thing is that here the formula is explained. Economic value added is equal to net operating profit after tax minus total capital employed. So that is what is that is total capital employed is nothing but weighted average capital employed into total capital employed gives the net operating profit after tax. So that we have to consider here. Next thing is about the market value added aspect is given in detail. Market value added is the difference between the current market value of a firm and the capital contributed by the investor. If NVA is positive, the firm has added value. If it is negative, the firm has destroyed the value. It is thing that it is simply we can understand the firm's return on investment is more than the cost of capital. That is, if the firm raise the fund at the rate of 15%, it should be able to generate income more than 15%. That is called as a firm has added value. Otherwise, it means that the firm destroyed its value. So the amount of value added needs to be greater than firm's investors could have achieved investing in the market portfolio. Another important objective of financial management is return maximization. This is the third objective of financial management. It says that to safeguard the economic interest of all the person who are directly or indirectly connected with the company. It is simply that stakeholders. What is meant by stakeholders? The person who are directly or indirectly interacting with the company or interested with the company or connected with the company, whether they may be they are shareholders, creditors or employees. All these parties must also get maximum return on the investment, and this can be possible only when the company earns higher profit to discharge its obligation to the firm. Okay, next we will discuss about the scope of financial management. So there are two important aspects in the scope of financial management. One is the traditional approach, another is the modern approach. What is the traditional approach? In case of traditional approach, the financial management is concerned with the arrangement of funds through financial institutions, that is in form of shares, bonds, etc. Looking after the legal and accounting relationship between corporation and its sources of funds. So this is the important aspect of traditional approach. So what is modern approach? According to modern concept, financial management is concerned with both acquisition of funds as well as the allocation. It is meant that how effectively the funds can be utilized. So here, what is it? The accounting is concerned with the routine type of work. It is related to financial planning and formulation and control. So here, financial management, according to the modern approach, the scope of the financial management comes under three important aspects: financing decision, investment decision, and dividend decision. What is meant by financing decision? Financing decision of a firm deals with the financing mix or financial structure of an organization. There is a difference between financial structure and capital structure. Financial structure includes both long-term and short-term funds. So what is the proportion of long-term funds and short-term funds? Short-term is nothing but working capital. Okay, then you can get a doubt that what is capital structure? Capital structure is the proportion of long-term fund. Here it is discussed only long-term fund. Long-term funds means there are two important sources of long-term funds. One is a owner's equity, that is nothing but common stock, equity shares. Another is the borrowed fund. Borrowed fund may be raised through financial institution or debentures. So here, optimum utilization of the funds is very important. The firm has to focus on how to raise funds at a minimum cost of capital and maximize the shareholders' wealth. That is the important aspect every finance manager will consider. So he has to find out the proportion choice between the debt and equity. Next important decision is the investment decision. That is the important aspect of financial manager. So what is investment decision? Here it is nothing but capital budgeting decision. Capital budgeting decision is nothing but the firm has to decide where they have to invest, how to invest. Okay, which is the profitable investment? The profitability of the particular investment will be assessed with the help of the certain techniques. That is the profitability payback period method, average rate of return method, that is otherwise called as ARR. These are the traditional method. Then the modern method, that is nothing but modern method means the present value of the money will be considered. Here, what are the methods means here net present value method, profitability index method, internal rate of return method. So here all these methods are used to assess whether we can accept the particular proposal or not. Okay, so the third important decision is the dividend decision. Every manager has to consider what is the proportion of money earned should be distributed as a dividend and retained for the future purpose. This choice is in the hands of the financial management. This is based on the availability of profitable investment opportunities in the hand. There are different models are available to determine the dividend policy of the firm. So the dividend policy depends upon purely on the investment, that is a profitable investment opportunities in the hand. And the third important decision of the financial management is the working capital decision. What do you mean by working capital? I have already explained difference between current assets and current liability. So every firm wants the certain portion of the cash flow to be maintained to meet day-to-day expenses. Day-to-day expenses related to the payment of sundry expenses, payment of electricity, purchase of raw material, payment of salaries, all these things. So in order to meet all these expenses, they require money. That is also one of the important aspect every financial management consider. So again, I repeat, working capital refers to the difference between current assets and current liabilities of the firm. While current assets comprises of cash, receivables, inventory, short-term securities, etc. Current liabilities consist of creditors, bills payable, outstanding expenses, bank overdraft, etc. So now we have discussed the scope and traditional and modern scope. So the decision is also we have discussed. Next important thing is the why financial management is important for every organization. The importance of financial management, we can say that first one is it helps organization in financial planning as well as acquisition of plan. So it helps to make a plan, how to raise, where to raise, and how to get the fund, acquisition of fund. Second thing, it also helps the firm to effectively utilize and allocate the funds received or acquired, as well as it supports the organization in making critical financial decision. It also helps in improving the profitability of the organization through proper selection of the investment proposal based on different techniques. Next thing, it also helps to increase the overall value of the organization. So it also helps the economic stability of an organization. So these are the important aspects the financial manager has to consider. So because of these reasons, the financial management is very important. Next, we will discuss the functions of financial manager. The functions of financial manager and the importance of financial management are some of the things are overlapping. Anyway, I will discuss what are the functions performed by the financial manager. First one is the estimation of funds requirement. How much funds required, how to raise it, where to raise it. So here the important function is determination of capital mix. Capital mix is nothing but proportion of debt and equity. Another important thing is the optimal sources of fund. What do you mean by optimal sources of the fund? So when the company wants to raise the additional fund, he has to decide what is the sources of funds he has to raise, whether they have to go for a shares, that is the debt or equity. Debt is a borrowed fund, equity is the owned capital. When the firm has a debt servicing capacity, that time only they can go for the when the firm has a debt servicing capacity, that time only they can go for a borrowed funds. So that is one of the important aspects they have to consider. Next thing is that the financial manager has to consider the investment of funds. What do you mean by investment of funds? So here he has to think about the allocate funds into profitable ventures so that there is safety on investment and regular return is possible. Okay, next thing is the disposable of surplus. Once the company earns profit, it has to take a decision that whether it has to distribute the profit as a dividend or retain earnings for future investment purpose. That is the important functions of the financial manager. So that is dividend declaration or retain earnings. Next thing is the management of cash. So every finance manager has to make a decision that with regard to the cash management, because liquidity is also very important. Whatever money they are having, they cannot completely park the amount in a profitable investment because they need cash also liquidity. That is, liquidity is very important to meet the day-to-day expenses, that is working capital requirement. So management of cash is a very important aspect. Last thing is the financial control. The finance manager has not only to plan, procure, and utilize the funds, but also he has to exercise control over the funds. This can be done through many techniques like ratio analysis, financial forecasting, cost, profitable, and control. So I think it's clear. Today we have discussed about the meaning of financial management. Meaning of financial management is nothing but it is concerned with the acquisition and allocation of funds. Then we have discussed what are the objectives of financial management. Objective of financial management are the primary objective, that is the traditional objective is profit maximization, the modern objective shareholders wealth maximization and return wealth maximization. This is the objective. Third is that what are the major decision areas of financial manager? One is the financing function. Financing is where to raise the fund, that is capital structure decision. Second is the capital budgeting decision. Third is the dividend decision. Next thing is that this is the decision areas of financial manager. Then why financial management is important we have discussed. Then what are the functions of the financial management. So these are the main things about the introduction about the financial management. So